it's important to kind of get a sense of when markets are going up or down, in this case, down, when is a good time to get out if you caught a short. So if you caught this market short and it's working in your direction, when is there a probability that it's going to bounce? It's going to bounce. And you're never going to be perfect getting out of winners. You try to, but you're always going to aggravate yourself. I could have made more. I could have, but you're paying, you're not just taking profits hard capital wise, you're taking emotional capital profits. And what I mean by that, if you were to get short up here and you get out down here and the market goes up and that comes down and would have given you another 5 points, you're mad. If I just would have hung on, I would add 5 more points. And you're always going to feel that way if you allow yourself to. You have to think, I don't want to be perfect, but I want to look for something objective to get me out. And it's not always just an arbitrary target. Say, okay, I'm going to get out at 22. What happens at 22 when it gets down there? Well, what happens was a big iceberg on the buy side, that's why it's green, appears. So if a big iceberg appears after a market moves lower, the probability of a little bit of a bounce, at least a little bit of a bounce, is there. You guys have seen and watched my videos over and over again. Let me back up this recording. So the market comes in, get a bunch of aggressive sell orders, and then you get an iceberg that is selling it, and usually they're chasing and they're late. Then a green iceberg appears, and generally you get this kind of pop. All right. So market comes down, comes in, gets hit, or we identify this iceberg, and that's the pop. So instead of just laying bids in the book to get out of a short, if you were fortunate enough to be short, qualify your exits just like you should qualify your entries.